Hi, I'm Bob. Price elasticity plays an essential role in analyzing the effects of a sales tax on consumers and producers. After today's video, we will understand that how much a tax affects the equilibrium price and quantity and how much the tax falls on consumers depends on the price elasticities of demand and supply. The most common sales tax is called the valorem tax. For every dollar that a consumer spends, the government keeps a fraction, which is the sales tax rate. The sales tax for food in the city I live is 7%. For example, if I spend $1,000 on food, the seller receives $930 and the government collects $70 as a sales tax. The other type of sales tax is called the specific tax or the unit tax. The government collects a specified dollar amount per unit of products sold. For example, the government collects $0.26 on each gallon of gasoline sold in the state where I live. Let's examine the effects of a unit tax on the equilibrium price, equilibrium quantity, and tax incidence on consumers. Suppose a unit tax is imposed on each ice cream cone, and it is collected from the producers. For every possible price P paid by consumers, the government takes the tax T, and the producers receive P minus T. Since the producers' costs increase, they are willing to supply less, and the supply curve shifts to the left. At the new equilibrium, the consumers pay P plus delta PD, and the producers receive P minus delta PS. The sum of delta PD and delta PS is the tax T. A unit tax causes the equilibrium price consumers pay to rise, the price that producers receive to fall, and the equilibrium quantity to fall. Now suppose the unit tax is collected from the consumers. The supply curve is unchanged, but the demand curve shifts to the left. The graph shows that the equilibrium price paid by consumers, the equilibrium price received by producers, and the equilibrium quantity are the same as the tax is collected from producers. So the equilibrium is the same regardless of whether the government collects the tax from consumers or producers. Next, let's consider how the tax is split between consumers and producers. The incidence of a tax on consumers is the share of the tax that falls on consumers. The incidence of a tax on producers is the share of the tax that producers pay. The incidence of the tax is unaffected by whether the tax is collected from consumers or producers. What determines the tax incidence? The answer is the price elasticities of demand and supply. It can be proved that for a given supply elasticity, the more elastic the demand, the less the consumers bear the tax burden. Similarly, for a given demand elasticity, the more elastic the supply, the less the producers bear the tax burden. That is, the relatively more inelastic party bears more tax burden. There are 4 extreme cases. If the price elasticity of demand is 0, that is, the demand is perfectly inelastic, then consumers absorb the entire tax. If the price elasticity of demand approaches infinity, that is, the demand is perfectly elastic, then the entire incidence of the tax falls on producers. If the price elasticity of supply is 0, which means the supply is perfectly inelastic, then producers pay the entire tax. If the price elasticity of supply approaches infinity, which means the supply is perfectly elastic, then consumers pay the whole tax. Today, we make predictions about the effects of a sales tax and learn how much the tax falls on consumers and producers by comparing the price elasticities of demand and supply. Thank you for watching this video and subscribing to my YouTube channel. See you next time.